Hey, welcome to the podcast, everybody, on this Monday edition. Thanks for joining me. Appreciate it. If you hear some weird noises, that's literally the wind hitting up against our window here. We basically have 25 mile an hour sustainable winds and probably bigger gusts than that. So it's quite windy out there, but also windy in the stock market today. The markets, of course, opened up this morning and quickly reversed, and we'll give you the reason in just a minute, but you can see this is a 5-minute picture, and you can see this is where we closed on Friday. So we kind of gapped up at the morning, and really we had, I think the Dow at one point was up about 70 points. The NASDAQ was up about 10 points, and it was right about up here. Sorry about that. And then, of course, reversed and started to head down the rest of the day. The last few minutes of trading, really the last 30, 45 minutes, really saw an accelerated downside move as panic and fear kind of picked up. And a lot of that was at least blamed on what happened in Italy. We had the Italian elections. Looks like nobody could claim victory. Looks like maybe a three-way tie, kind of like a hung jury. And the markets, which were rallying quite heavily, all of a sudden reversed course and down we went. And it wasn't necessarily one thing started it. Everything kind of happened at the same time. But if you were in the Italian stock market, which probably most of you are not directly invested in that, gap up this morning, about a 4% gap up. So, this just the ETF alone, if you want to invest in Italy, EWI, 1294, 1293 was the previous close, gapped up to 1345, big move, gave all of it back within the first hour or so of trading. We headed down, finished at 1220 on the day. So an amazing move in one day over in Italy. And you can imagine that kind of trickled everywhere. I mean, here's the picture of the yen, the euro, all these things were moving dramatically, big moves in one day. I'd actually been looking at the yen as a possible trade, given that, it had been crushed, right? And so just as a kind of a rebound, thought this might be an interesting play. And this morning, as it was down, I thought, boy, it's a good thing I didn't do that. Well, it turns out the yen, this ETF actually moved 2.29% in one day, which is a big move for a currency, and you can see that on here. But all these things reversed. Of course, the stock market, we talked about it on Saturday, had this, a potential place here about the 50-day moving average, which right now is at 1476. That gives us another 12 points to the downside potentially we could have before we get to, a place where buying should, quote, should. And we talked about, look, this thing was setting up for a potential pullback, and we said, don't play things one way or the other. Now, if you were somebody that came in net short, you were probably freaking out a little bit this morning when you saw the futures, and then if you had the guts to hang in there, you made really good money. For those that are extremely long, we mentioned that was a problem too. If you're 100% invested and getting very complacent, we said that would be a problem. You have to constantly be agnostic in this market. Don't really want it or wish it to go one way or the other. Yes, you're going to be positioned to benefit from one direction or another. You can't be always neutral, right? Otherwise, you wouldn't make any money. But my point is that look at it agnostically to know that, hey, I've got certain systems set up that if certain things happen, I'm going to do X, Y, and Z. And, part of what I do is I want to, and I've mentioned this before, we stay in some of these exchange-traded funds, different sectors, different areas of the market that are showing the most strength with the least amount of volatility. And we kind of rotate in and out of those on a monthly basis. And so I already know right now that, I'm going to make certain moves in the next few days here. And I'm not worried about the market going back down to 1,300. I'm not worried about that right now because, again, the way I've got this set up is that I will scale down the risk when need be. And so, again, I already have these conditions set. And that's a system in place, and it's important you do some of those things. Otherwise, you're caught like a deer in the headlights going, should I sell on a day like today? Everybody's panicking. What should I do? The market's going down. Small caps and mid caps are down 2%. What should I be doing? And you need to exhale a little bit and say, look, I've got my system in place. I already know what I'm going to do to a certain extent. What we don't know is how big a correction is, right? I mean, if it's a one-day correction, then of course you have the potential to be whipsawed, and meaning you sell today, you come back tomorrow, it's up in the morning, and now you're completely on the wrong side of the trade. I think some people did that this morning. Think about it. The people that sold a couple of days ago because they said, "Oh, the market's rolling over. It hasn't had this type of drop in, a couple of months. Surely it's got to roll over." They come back, the market rebounds that day. It goes up the next day, up 100 and something points, and then now they're out. Maybe they jump back in on Friday, only to see it reverse and go down today. So don't be one of those people, because it's very easy to do that if you let your emotions take control of what you're trying to do. And, this Italian vote, I don't think this is a reason for global sell-offs, but it's being used as an excuse to take profits. And I think that is, the market may be looking for any excuse to take profits when it's so extended as it was. And so it's now lower than it was a couple of days ago. And obviously we are, this is the lowest point we've been since, back here in January 23rd. So over a month now, it's the lowest point we've been. And again, the first place we want to look at is this 50-day moving average, which is this blue line. And then we may come back, if it doesn't do that, we may come back and go through that and end up down in the 1467, 1466 level, which would be another 22 points, another couple percent down. That would be another logical place for this to try to bounce. After that, then you're maybe looking at the 200-day moving average. So you got these levels that or buyers may come in. And if they don't, then we know we're going to be in for a little more of a serious correction. Again, I still don't think this is a bear market, but this is could be setting up for a correction. And again, if you're somebody that's positioned moderately, then certainly you're not losing sleep at night worrying about a whole portfolio just getting slaughtered because you're using margin and you're 100% in stocks. So you can see Italy again was the deal here, in this huge bar down 6% on the day after being up 4%, so about a 10% intraday move, huge volume. And isn't it funny, after everything you hear about treasuries, on a day where people get scared, where do they turn? They always turn back to treasuries. And treasuries are interesting because we've had this nice methodical downtrend where treasuries have hit this level several times on the way down, meaning if you were long treasuries, so you thought interest rates were going up, and they were going down, you've been getting hurt because every time they started to rally, they would have trouble, and which meant interest rates kept going up, and people were getting worried that maybe this is the end of this bond bull market. But yet all it takes is one nervousness day in the market, and look what happens. You get this big volume burst of TLT, which is long treasuries, big reversal. And this hollow candle, what that means is basically treasuries went up all day long. So they continued up all day long and closed at their high of the day, up about 2%. So that has broken now. Any little pullback may be a buy there, and you could set your stop, but that may be an interesting trade, again, if you're looking for a shorter term move. Now, let's take a look at gold. We talked about this last week, how it was, again, still has a place in the portfolio. As long as the Fed's balance sheet continues to grow, gold still has a place. It was oversold, and you can see we have had a bounce. Not tremendous, but a nice bounce today, almost 1% on the GLD. And also for those that are a little more technical, these are Bollinger Bands, and kind of 2 standard deviations away from the mean. And you can see how gold was outside of it for really about 4 days in a row, and now it's come back into it here. So what we would be looking for is a move, kind of a measured move, up to maybe the 50-day moving average. And then, again, I said at 160 or so, that would be the place that you would get out if you're wanting to trade gold, which I still think gold is, I don't want to say an investment, but for a piece of the portfolio, I think it's an investment. So, again, money went into gold today. On a relative basis, it went into pharmaceuticals and utilities, and obviously as the safe haven, it went into treasuries. That was someplace that went. Volatility, very, very big day, 35% jump in the VIX today. You haven't seen a move like that in quite a while. 35% move. So the volatility spiked up. Now here's the key. If you believe we're in a bull market in stocks, when you see these types of spike ups in volatility, which is a quick rush to buy protection, those have been your buying times. And I think while today may not be the day, perhaps we're close. But there's no sense in you being the first one in. But this is something that we watch is, again, you have to determine what kind of market you're in, because remember back in the financial crisis, '08, when the VIX would spike, that was just that was showing that the fear was picking up, but the fear was the correct emotion back then. And it was kind of the opposite. Every time the fear went away, that was a good time to sell. Now, what's been happening is every time we see temporary fear, it's been a good time to buy. And until something major changes, I don't see why this will be any different. But again, it's kind of early right now, and I think overall the stock market it was poised for a correction. We're getting that correction. It's using Italy as an excuse, and it's pulling back now. So, but again, the general areas for the market are right here with where I would look for it to try to make a bottom. And if it breaks on through, then of course, obviously, by definition, it's going lower. So again, position yourself properly to where you don't have, if you've been looking to buy, you buy on fear, right? If you have been looking to, if you're heavily invested, you probably did have some stops that got taken out, and that was the right thing to do. And if you're a short-term trader, you can take advantage of it. But overall, this correction that may be materializing doesn't change the overall picture yet. And at least it doesn't for me, because I haven't seen a lot of indicators saying that, hey, this is going to be a major correction. So I just wanted to get that out to you, just to kind of let you know what happened to do today and why. And again, stay flexible and stay agnostic. Be flexible to say, hey, you know what? If I thought this and I'm wrong, I will change my position and move on. Right? That's how you succeed over the long term in the market. Anybody can succeed over a couple of months, even a year or so, but it's those times like '08 and 2000 and 99, those times where you have big major moves where you really learn how to do this, because if you go to the death with a theory, or hey, I believe this is going to happen, and so I'm going to position myself that way, you're going to lose money over time because you're being stubborn. And that's why it's better to have these systems in place, have these indicators in place, and then just follow them. And if you do that, you can make money during good times, and you can, more importantly, protect capital during extremely volatile times. And obviously, one day does not make a volatile time. We're talking about the summer of 2011 during the debt downgrade. We're talking about the financial crisis. We're talking about the 2000, 2002. That time frame, the tech bubble. Those are times where people got caught buying dips and nothing really had changed. And so, again, though, having your systems in place will help you a lot, because you won't freak out on a day like today. All right, have a wonderful day, and we will talk to you soon.